How the US stock market works. NYSE Nasdaq. The United States stock market is the largest and most influential financial market in the world. Every day, trillions of dollars worth of shares are bought and sold by investors, banks, hedge funds, pension funds, and ordinary people. Companies such as Apple, Microsoft, Amazon, Tesla, Nvidia, and Google have become global giants because they can raise money from investors through the stock market. But how does the US stock market actually work? What are the New York Stock Exchange, NYSE and Nasdaq? Why do stock prices change every second? Let's explore the complete process. What is the stock market? A stock market is a place where investors buy and sell ownership in companies. This ownership is divided into small units called shares or stocks. For example, imagine a company is worth $1 billion. It may divide its ownership into 100 million shares. If you buy one share, you own a tiny part of that company. As the company grows and earns more profits, the value of its shares may increase. Investors can then sell those shares at a higher price and make a profit. However, if the company performs poorly, the share price may fall, leading to losses. Why do companies sell shares? Growing businesses often need large amounts of money to expand. They may want to build new factories, develop new products, hire employees, expand internationally, pay off debt. Instead of borrowing money from banks, companies can raise capital by selling shares to the public through an initial public offering, IPO. During an IPO, investors purchase shares, and the company receives billions of dollars for expansion. The two largest US stock exchanges. New York Stock Exchange, NYSE. Founded in 1792, the NYSE is the world's oldest and largest stock exchange by market capitalization. It is located on Wall Street in New York City. Many famous companies trade here, including Coca-Cola, Walmart, Disney, JP Morgan Chase, Boeing. The NYSE traditionally uses a combination of electronic systems and human market makers to match buyers and sellers. Though Nasdaq began operations in 1971 and became the world's first fully electronic stock exchange. It is especially popular with technology companies such as Apple, Microsoft, Amazon, Nvidia, Meta, Tesla. Unlike the NYSE's traditional trading floor, Nasdaq operates almost entirely through computers, allowing extremely fast trade execution. What happens during an IPO? Suppose a company wants to raise $10 billion. Investment banks help determine the company's value and decide how many shares to sell. Example: company value $100 billion. Shares issued 2 billion. IPO price $50 per share. Investors buy these shares, and after the IPO, trading begins on the NYSE or Nasdaq. From that point onward, the company no longer controls its share price. Investors determine the price through buying and selling. How stock prices change. Stock prices constantly move because of supply and demand. If more people want to buy a stock than sell it, the price rises. If more investors want to sell than buy, the price falls. For example, a stock is trading at $100. Thousands of buyers place orders. Very few investors want to sell. The shortage of shares pushes the price upward. Later, if negative news appears, many investors may rush to sell, causing the price to decline. What makes stock prices rise or fall? Many factors influence prices. Company earnings. Every quarter, companies report profits. Higher than expected earnings usually increase share prices. Weak earnings often push prices lower. Economic data. Investors closely watch inflation, employment numbers, GDP growth, consumer spending. Strong economic data generally supports higher stock prices. Interest rates. The U.S. Federal Reserve controls interest rates. Higher interest rates make borrowing more expensive, which can reduce company profits and stock valuations. Lower rates usually encourage investment and economic growth. News and global events. Wars, pandemics, elections, natural disasters, and technological breakthroughs can move markets within minutes. Who trades stocks? The stock market includes many participants. Retail investors. Ordinary individuals buying through apps like Fidelity, Charles Schwab, Robinhood, or E-Trade. Institutional investors. These include mutual funds, pension funds, insurance companies, hedge funds, investment banks. Institutional investors often trade millions of shares at once and account for a large portion of daily market activity. Market capitalization. A company's size is measured using market capitalization. Formula. Market cap share price total shares outstanding. Example. Share price $200. Shares outstanding 5 billion. Market cap $1 trillion. Companies are generally classified as large cap, mid cap, small cap, major U.S. stock indexes. Investors often follow market indexes instead of individual stocks. S&P 500 tracks 500 of America's largest companies. It is considered the best indicator of the overall U.S. economy. Dow Jones Industrial Average contains these major American companies. It is one of the oldest stock indexes. Nasdaq Composite includes thousands of technology-focused companies listed on Nasdaq. It is heavily influenced by firms like Apple, Microsoft, Nvidia, Amazon, and Meta. Trading hours. Normal trading takes place सुबह के 9:30 to शाम के 4 बजे Eastern Time. There are also pre-market trading, after-hours trading. These extended sessions allow investors to react to breaking news before or after the regular market closes. Bulls versus bears. Two common market terms are bull market. Prices rise steadily. Investor confidence is high. Economic growth is usually strong. Bear market. Prices fall by 20% or more from recent highs. Investor confidence weakens. Economic uncertainty increases. Markets naturally alternate between bull and bear cycles over time. How investors make money? There are two primary ways. Capital gains. Buying shares at a lower price and selling them later at a higher price. Example. Buy at $100. Sell at $150. Profit $50 per share. Dividends. Some companies distribute part of their profits to shareholders. Investors receive regular cash payments while continuing to own the stock. Risks of investing. The stock market offers significant opportunities but also involves risk. Major risks include company bankruptcy, economic recessions, inflation, rising interest rates, market crashes, geopolitical conflicts. Diversification, owning stocks from different industries, can help reduce risk. Why the U.S. market leads the world? The U.S. stock market attracts investors globally because of strong legal protections, transparent financial reporting, large, innovative companies, high liquidity, stable financial institutions, access to global capital. Many of the world's most valuable companies are listed on the NYSE or Nasdaq, making these exchanges central to the global economy. Conclusion. The US stock market is much more than a place where people buy and sell shares. It serves as the financial engine that helps businesses grow, creates wealth for investors, and reflects the health of the American economy. The NYSE and Nasdaq provide platforms where millions of trades occur every day, with prices constantly changing based on supply and demand, company performance, economic conditions, and investor sentiment. Understanding how stocks are issued, traded, and valued helps investors make more informed decisions. While the market can be volatile in the short term, history has shown that disciplined, long-term investing in strong companies has been one of the most effective ways to build wealth over time. Whether you are a beginner or an experienced investor, learning how the US stock market works is an essential step toward understanding modern finance.